Do you look at June as the worst of it? Energy's going to fade? Or do you look at June as evidence that this is stickier? We've got to get used to this being with us for longer, and this Fed has got to do a whole lot more.
I think that actually we're pretty much near the peaking of the CPI. Yesterday may not have been the absolute peak, but the next month I think surely will. And what I'm concerned about is the Fed focusing so much on the headline inflation. They're losing track of an economy which is losing momentum, real wages which are declining, and pretty much around the world you see economic distress. Emerging markets have debt problems. Europe has very slow growth problems. And I'm afraid if they pursue their typical path of aggressively tightening, focusing on inflation, that they will do real harm to the economy. That's what I think the stock market is telling us here.
Margie, you just said pretty much around the world. You're too young to remember 1998. Unfortunately, Margie, I remember it. And all of a sudden, the correlations click in. How far behind is pretty much around the world? How far behind is EM, et cetera, from what we're seeing in major things we're focusing on?
Well, I think that's a very good point, that when bad things happen, they tend to get clustered and happen all at once, and everything is correlated down. And that almost looks as if we're on the precipice of that with the aspect of what the Fed is going to do. So, yes, I think it's happening more or less simultaneously. Emerging markets have had big problems building for years, and it didn't matter until we had this huge spike in basic commodities. Again, Europe has its own problems with energy, low growth. So this, to me, says this is a time where the market's reflecting economic reality, not necessarily where rates are. Rates will come down on inflation as we see a much slower economy.
Margie, based on what we have seen with the CPI reports, and perhaps not what the Fed should be following, but what they are following, have you changed your positive outlook, particularly on risk assets?
A little bit, yes, because it seems that it's going to be unavoidable to not have a real earnings slowdown. I think it'll be interesting this quarter. I think earnings will be pretty good or surprisingly good, but their outlooks for the rest of the year, I think, may be much more guarded, and I don't think the market's going to like that. I think it all rolls back to the economy's losing momentum, and the Fed is aggressively tightening. They're looking in the rearview mirror, and it seems like they want to repeat the mistake they've made in other cycles.
Margie, when it's like this, what do CFOs do? Do they issue more debt? Do they use this as an opportunity?
Well, they have been doing that over the last few years. They really have taken advantage of near zero interest rates. Investment-grade companies, companies that don't need the money at all, like, say, an Apple, and also junk companies have also aggressively raised cash on their books, so their balance sheets are very strong, so they won't be cut off by the banks, so they can ride through a downward cycle in the economy. So corporate America really looks pretty good because they've already done that borrowing.